In today's episode, we're speaking to Jonathan Blau. Jonathan is the founder of and the CEO of Fusion Family Wealth, a Long Island-based fee-only registered investment advisory firm. His investment philosophy is centered on helping shape positive money behavior and by teaching wealthy people to consistently make rational financial decisions under uncertainty. As an industry thought leader in behavioral finance, helping investors to learn to make rational money decisions under conditions of uncertainty, Jonathan helps clients thrive by helping them identify biases that drive poor money decisions and then helping to modify their money behavior. Let's speak to Jonathan and find out how he changed his life by changing his mindset. Let's find out. Welcome. This is Gull, your money mindset expert. And today I'm so excited. We're speaking to the amazing, the wonderful Jonathan Blau. Welcome, Jonathan.
Thank you, Gull. It's a pleasure and honor to be a guest on your podcast today. I'm looking forward to it.
Thank you so much for giving us your presence. Thank you so much. Jonathan, everyone's heard your intro. They know how fabulous you are, but please, in your own words, tell everybody what it is that you do.
All right. So what we do is we try to help wealthy investors, wealthy people who've been successful in life, who now are charged with the responsibility of trying to manage that wealth, to learn how to make rational decisions about the money they have when they're faced with conditions of uncertainty, which I guess is almost always, right? We're always in a condition of uncertainty. So we help them to come up not only with a plan, but to learn how to adopt the steps and the behaviors that are needed to bring that plan to its most likely highest level of completion. And we do that by identifying the biases that drive poor decisions and then helping them modify the investment behaviors driven by those biases.
Fabulous. So essentially you help entrepreneurs or people who have come to money with actually investing and reaping fruits from, basically the benefits of that wealth, whether it's through business or through sale business or through some other form of inheritance or something like that.
That's right.
I think that would make sense because I think there's a more demand for it. And somebody listening may think, well, how much demand could it be? So let's answer that question, because my understanding is, and I'm in the entrepreneurial world, there are far more millionaires now than there ever were in history, from what I remember. And so-called new money, through the digital money has become so prevalent, and people are able to, build a company and sell and so forth. So is that common? Is there a lot of people with a lot of wealth? Because what the media likes us to see is all the poverty and all the things that are going wrong with the world. So what's your opinion about that? Let's start with that.
Tremendous amount of wealth creation. I mean, there are millionaires being created in our country alone, from the statistics I've seen, certainly daily. So I think that, as you say, media likes to appeal to human nature, and human nature likes to focus on what's negative.
Yeah,
because that's how we function. So you're right. It's kind of like watching the news. They never report how many airplanes this year took off and landed successfully. They only tell us about the one that had a mishap, and that becomes what's available in our mind, that we tend to use as an anchor to make decisions on flying or not.
Yep. I completely agree. So let's talk about your journey. So how did you land in this wonderful land of investment and helping people? So how did it all begin for you?
So that's a good question. I started off as an intern in the summer of '87, working for a successful, in those days they were called stockbrokers, at a firm called Lehman Brothers, which unfortunately is no longer around as a result.
Yes, since 2008.
Right, but they were around for over a couple of hundred years. And
yes, yes, that's a story to be had. I think, and nothing's ever permanent in this world, And that was one of the oldest banks and been barely up.
The change is a constant, right?
Yeah.
So I spent 2 summers there, and from there I went on to graduate school, and I wanted to pursue a degree in accounting, a master's in tax and MBA in accounting. And what I wanted to do is learn the technical aspects of wealth that investors and families deal with. So that's why I want to learn the tax aspects of what's involved. Then from there, I went on to a firm called Sanford Bernstein, which is now called Alliance Bernstein. At the time, was the largest privately owned money management firm in the U.S. And then from there, I had different iterations at Morgan Stanley, and a couple of the other big, what they call wirehouse firms, UBS and Citibank, Smith Barney. And what I learned in 2000 to 02, which was about 3 years after I had left public accounting, Arthur Andersen was the firm I was with. I joined Sanford Bernstein. I was 29. I was fortunately the youngest person they had hired directly as an advisor, as opposed to an advisor assistant. And what I learned there in a 6-month training program, there was one day on what's called behavioral finance, which deals with essentially money and uncertainty and how to make decisions in that context. And that always stuck with me, but I never pursued it at a very young age. From 2000 to 02, 3 short years after I started my career in money management, I was faced with a 50% decline in stocks. And so essentially all of the clients I was trying to help that I had worked hard to gain trust from in my first 3 years, let's say we had about 100 million, and then quickly from 2002 it became 50 million.
Oh, wow. Okay.
Yeah,
That's a significant drop.
Significant drop in the client's experience as well as in our business. And then from 2002 to 2004 or 5, we were able to rebuild. And then just 2 short years after that, in 07, we experienced the beginning of the entrance into the financial crisis. And so then we went down in half again, almost 60%. Right. So that was the first decade of my career. What I learned was I was spending a lot of time talking my clients off the same cliff the day I was talking to them that I talked them off of a month earlier and a week earlier and the day before. And I decided there had to be an easier way to help these people and to help the practice be calmer at the same time. And that's when it hit me like a light bulb. We have to not worry about explaining to them how investments worked over the long haul and trying to convince them to stay with it. We have to address the psychological issues that are driving those behaviors so that they don't manifest themselves as often. And that's when we got into behavior.
Okay.
So if you've heard the saying in investing that past performance is no guarantee of
exactly, yeah, they always say that, yeah.
What I like to say is, and this is not just as it relates to money, but in life, past behaviors are the closest thing to a guarantee of future behaviors.
Future behaviors. Yeah, I agree. I think that's a perfect way to describe how human psychology works. If we behaved in a certain way up until a certain point, unless there's an external reason for us to behave differently, we are going to behave in the same way. And even if we do have external factors working on us, it's still we go to the status quo. We want to go back to what we find normal, and we end up behaving the same way. That's why charts are predictable, right? So because I do a lot of trading, not so much recently now, but before. And the whole idea of why the charts work is because that's based on human psychology, and people behave in a similar fashion. Doesn't matter if it's 20, 30 years apart. They tend to behave very similar way. And that's how we get some sort of predictability, not really that much, but as much as we can.
Well, you're right. I mean, I don't know if you know Morgan Housel. Morgan Housel is a prolific writer in finance and psychology, and his brand new book is called The Same as Ever.
Yeah.
And it just came out last week. And what he basically talks about there is what I call the immutability of human nature.
Yeah.
That you can't succeed in life by worrying about predicting the future, because you never will be able to predict the future. And the big things that are the turning points in life in general, in history, are things not that you could have predicted. It's the big black swan events, right? So he was recounting a story, World War I. There was a ship heading toward Germany, and they shut off one of the engines to save fuel and to make it more efficient. So because of that, they got to the destination a day later, and because of that, there's a German ship that torpedoed them, and 1,000 or more people died, and that's why the U.S. entered into World War I. So had he not shut that one engine to save energy, they would have been there earlier, and
Earlier.
that event never would have occurred. So it was one of
Yeah.
his examples.
Yeah, I think that this is something that I think when we can talk practically, and we can talk from the from the psychology point of view, but we sometimes have to take a step back and say, oh, maybe there's something greater, some divine source come into play, because things happen, even so-called bad things. You think, oh, this is such a horrible thing, but certain things need to happen in order for the next things to have the domino effect. And without one, the other doesn't happen. As you just mentioned, and I wasn't aware of it, had that German ship arrived a day earlier, then it wouldn't have been bombed. It wouldn't have been bombed, and then USA wouldn't have entered into the world, into the war.
Yeah,
and
it
then
was a U.S. ship that was headed that way, and the German ship bombed them.
And
And
obviously,
that's
of
how we
course,
got in.
and then that's the reason why we're, I think the Uncle Sam's help was needed for World War I and World War II.
For sure.
Yeah. It's funny how divisive energy works, and sometimes bad things lead. I think all times bad things lead to good, great things, or something which is a positive outcome. I think generally that's how I look. So
that's right. You can't always predict what's going to happen because of what happened before, right?
So let me ask you this. I mean, this is such a difficult area to be, because you're sandwiched between two things. And I don't know if you recognize this, but I'm just thinking about what you do. So you're, on one hand, you'll have your clients, and they have made this money either through, I mean, it's unlikely that in this day and age that somebody would inherit as much as money. It's usually, well, maybe the next generation would, but I think my generation or whatever, it's unlikely. It usually happens that they've made a business and they've exited or whatever. So that's generally where most millionaires are made nowadays.
That's right.
So they've put this 5, 10, 20 years of hard work. Now they've exited the business. They've got lumps of money, 5, 10, 20, 200 million, whatever it is. And then they are giving you the responsibility of looking after that's their lifelong hard work, so to say, right. And then you've got other types, at the other end you have other people who are not your clients, and who think, well, they have so much money, why are you helping them to get more money? You're helping the rich stay richer, and well, what do you get out of it, and this is so materialistic, and all of that kind of malarkey.
Right.
You'll have those people probably in your ear as well. What are you worried about? So I've lost 5 million or 20 million. Oh my God, from 100 million to 50 million. What's a big deal? That is a big deal, right? That's 50% drop. And of course, that's 50% of someone's livelihood. So how do you balance that? That's my question to you. How do you balance the expectation of your clients? And how do you balance those naysayers who are, well, why are you helping them make more money in the first place?
So it's a good question. Look, I don't really get confronted by the naysayers often. So I don't really have to address that. I can't remember the last time I've had to address it. So
I'll ask the question first, and then I'll come back and I'll let you add to why I've asked that question.
Okay, so look, what we try to do with everybody is to try to help them to figure out what they want to figure out most. So what do most people want when they come to sit with someone in my seat who's an advisor? They're looking for, I put in one word, certainty. As much certainty about their financial future as they can possibly get.
Yeah.
And the challenge is, I work in an industry that's all too happy to address that problem by handing them what I call the illusion of certainty. And so they'll tell them about how many analysts they have and economists they have, and they'll be able to forecast consistently what the economy is going to do, and use that forecast to tell them when to get in and out of industries and sectors and the market in general. And no one can do those things consistently. So rather than hand back that illusion of certainty, what we do is we teach them how to make rational decisions given a constant state of uncertainty. And so we want to help everybody that way, regardless of how much money they have. So now, what is it that they need to do? We work in an industry that defines risk and safety in terms of protecting principal. So somebody sold their business for $10 million and they need to spend $400,000 a year. The industry is going to tell them, well, you're in your 60s, you can't afford risk. The industry defines, again, risk and safety in terms of protecting that principal. Not just from disappearing, but even from fluctuating. They call volatility. And in doing that, they tell the client to have bonds, more bonds. Bonds actually freeze the principal. Every $1 million invested in a bond that matures in 20 years can only give you back $1 million, when you need a lot more than $1 million in 20 years to buy what $1 million bought today.
100%. Yeah, of
right?
course.
So the industry's advice is generally teaching people to instead of measuring risk and safety the way it needs to be measured in terms of protecting our purchasing power, the ability of each dollar to maintain its value relative to inflation. What the industry is concerned with is helping clients to manage the fluctuation in the numbers of dollars they have periodically
Mm.
or market movements. By addressing that the incorrect way, they kill purchasing power, right? And so individuals are attracted to that because the way we're programmed is we're much more sensitive to changes in the value of what we have than to the actual value. So we have what's called loss aversion bias. The pain of a loss is felt to us 2 times more than the pleasure of a gain is felt pleasurable. And because of that, we're much more sensitive in the short run to protecting against fluctuation. And in doing so, what ends up happening is we adopt strategies that are designed to protect against short-term fluctuation, which is more bonds. Those very same strategies are destructive to long-term wealth protection and growth. And
Mm.
so we help people to realize that and then to kind of unpack that baggage and learn that it's the opposite. You need to invest in things that will maximize the long-term value of what you have. Oftentimes, those are the same things that will maximize the short-term fluctuation of what you have. And so those are the things we need to help them reconcile.
Well, thank you for that. I think that's, and I completely agree. You do. You need to. You have to manage risk along with, with the expectation of the ROI, because the returns are obviously, the higher the risk you're willing to take, the higher risk appetite, the more you're going to get the returns. And if the risk appetite is really low, then obviously the returns are going to sort of reflect that as well. But
Well,
my
and to
question,
your point, that the critical thing there is the risk. So to us, risk is not volatility or fluctuation. Risk is the chance, I say it this most simple way I know how, the chance that my last dollar may leave me before my last heartbeat. That's the only risk that a plan should be, in my view, designed to address. So when we define risk in terms of volatility, and you say, what's your risk tolerance? I would say, what's my tolerance then for running out of money, not what's my tolerance for watching some short-term fluctuation. So that is a big difference. And it's so
that's a big difference. That's a
yeah.
big difference. I think that to understand that, it's actually vital to be able to have investments. I mean, even small ones. I've got some money in ISAs UK. I don't know what the US version of that is, but this is this is tax free. So whatever grows in my ISA account, it
Okay.
won't be taxed. So and
How
there's
do I get involved with that?
well, I pay tax firsthand. So they gave you this first. I pay
I'm
tax
only
before,
teasing. Yeah.
and once it's taxed, I can put it into my ISA. But I know that if I've got it into shares, and they go up and down. So they are very volatile, and and so the amounts can decrease quite a bit. And it's sort of, I know that I'm okay with it, decreasing over time, because eventually it will come back up and it will be fine. So I'm able to, one, have my risk appetite is quite high anyway, but secondly, I know I'm expecting volatility, but then that's because I'm sort of educated in the financial world. How do you help or make your lay clients, your normal clients who are not versed in the financial jargon or the financial words, understand that? How would you help them understand, and how would you take the responsibility for that? That's my question. More importantly, we'll ask the
Right.
strategies next, or more on money talkies, but at the moment this is more to do with you. How do you work on your mindset? How do you help your clients to work with a healthy money mindset, in order to be able to have this, because they have to have
Sure.
some risk appetite in order for them to go ahead and take your advice?
Well, so let's address, I guess, what I'll try to answer what I think you're asking me directly, which is how do we help, as you say, the layperson? Now, I will tell you that financial success, when it comes to investing, our strong belief is that it's one part intellect, what we know, PE ratios, finance, or anything else. 99 parts temperament, what we do. So
Yeah.
the smarter the person in terms of how much they've studied finance and investing, the worse they're likely to be as an investor, because they're overconfident in skills that are not relevant to succeeding in investing. And so they go head first the wrong way. So the first thing we try to do is we advise both of those people the same way. And that goes to what I call the immutability of human nature. So if we had 10 people that we met in a week, and I spoke to each of them, and two of them were very successful entrepreneurs that I was trying to educate, and two of them were people who inherited money, never went through college, and two of them had PhDs in finance, etc. The question I need to ask to help people understand what you're asking is, are any of those people less likely than the other, based on their achievements in business or educational achievements, to have bailed out in 2008 in abject terror of the financial crisis, to bail out of some or all of their stock investments? And of course, the answer is no. And is each of those people less likely than the other in 1998 to sell everything else other than dot-com stocks to chase the dot-com bubble? And the answer, of course, is no, none of them are least likely than the other. So it's what we do, not what we know, that leads to success or failure in investing. And because of the immutability of human nature, we all are going to do the same things. That's Morgan Housel's book, basically. It's like, don't worry about predicting the future. Learn how we always act as human beings, and that will help you more than anything. So what we do is we teach everybody at the beginning by asking them some questions. So I might say, what is it that you most hope will happen to you financially for the rest of your life? So Gull, if I said it to you, you can answer. We could do a little bit of a role play. What would you say?
So ask the question.
What do you most hope will happen to you financially for the rest of your life as you're engaging in investing now for your future?
My investment to grow.
Right. Okay. And what do you fear might happen in that regard?
That because my risk appetite is quite high, I may, take unnecessary risk, and my pot becomes zero, and I'm at a later stage when I'm not able to replenish it. So the moment I sort of laugh about it, because I've lost so much money, and I make stupid investments. I make good investments too, by the way, so not just dumb ones, but I made some really, really dumb investments where I've lost like 100K within the space of a couple of months or something like that. And not to mention I have made 100K in less than a couple of months as well. It works both ways. But I'm not worried, because I'm very confident I can make money. I'm very good at making money at the moment, but I'm really young at the moment. My concern is when I'm older, and say when I'm 70 or 75 or 80 or 90, I think I still probably will be working by 80, 85. But say if I'm 90 and I'm not able to do the things I can do now, and my mind isn't as alert and active as it is now. What if I make a big, boo-boo, and I end up losing my pot of money? That's my concern.
That's your concern. So many people share that concern. And then a follow-up I usually ask them, which is, how do you suppose that can happen investing, the way we're talking about? And they usually will say something like, well, 2008 and 9 might happen. I retire, I invest, and all of a sudden the market's down 60% in a matter of a year, or 2000 to 02, the technology bubble. Those are the things I feel can hurt me. So then I begin to teach them. So their fear is, and I talk, when I use examples of investing, of a diversified stock portfolio, and I always use, just as an example, the Standard & Poor's 500 index, the 500, what I call largest, best managed and most profitable companies in America and the world. So that's what I use as the example. So if you have someone come to the table, and the fear they have is that they could somehow lose their money permanently, and the way that can happen is the market could decline, like it did at some episode that they highlight in the past happened. That becomes a problem, not of educating people about how the financial markets work, because the financial markets, even today, we're probably 7% from all-time highs, give or take, right? So no one has ever lost money in a diversified portfolio like the Standard & Poor's 500, yet everyone comes to the table thinking that there's a clear and present danger that could happen to them, a permanent loss investing in stocks that way. And so it's not a problem. Again, I can show them the whole history from the time I was born in the 60s. The S&P was 60. We went through, in the 1960s, Cuban Missile Crisis. We went through the Vietnam War. And in the 70s, we went through the decoupling of gold and the dollar, and Richard Nixon having to resign, and an energy crisis, and a horrible economic decade of unemployment, interest rates, and inflation, all approaching 20%. Makes
that was awful.
like a cakewalk, right? So we go through all of that, and I can tell them the other thing that happened during that entire period, including through 2001, the terrorist attacks and the pandemic, is the S&P 500 went from about 100 in 1970 to about 4,300 today. So a million is 43 million. And inflation barely went up 10 times during that period. So what it teaches them is that it's never happened what they're afraid of. So it's a problem of psychology, and I would call it abnormal psychology, because
Right.
it's the deep belief that something can happen, the loss permanently of some of my money investing that way, in the face of being able to show that it's never happened, right?
Mm.
Yet they still come and they believe it, and that goes to the education, and to kind of, you mentioned earlier how the news reports things. These are the narratives that are stuck in their head. So they're just thinking about the plane that crashed. They're not recognizing how many planes go up and down. So they decide flying is dangerous, right? They don't realize how many planes go up and down all year that don't have an incident. As it relates to stocks, the same thing.
I agree. I think the educating, I think the advice of education, you don't have to educate them completely on how the investment's done and how, you know, the intricacies of why they go up and down and the volatility, but you need to have some sort of mindset around it. Okay, I know that, you know, there's going to be some volatility. I'd have to understand the ins and outs of it, but I know that my investment, my capital is safe, and overall the next 5 to 10 years, I'll be fine and my money will be safe, right? And
That's right. And they also need to understand how they're defining safety. Remember, they're defining safety in terms of this volatility, this what I call this illusory risk that I
yeah,
call, as opposed to the real risk, which is the over a multi-decade horizon of retirement. As you said, you had
yeah.
yourself to 90. You're right. That's our life expectancy. So you have, someone in retirement could have 30 years. So
Yeah.
their real risk is the erosion of their purchasing power. And by having too much in bonds or not enough in stocks,
Mm.
which is the only thing that I showed you can keep up and surpass inflation, that's the real risk. So by taking on bonds for the illusory safety of protecting against the movement temporarily up and down of the value of the assets, they're ensuring failure to keep up with the cost of living. So if they still have that million in 20 years, they can only buy maybe a $500,000 of goods and services with it. They've long since begun to unravel their principal to make up for the difference in the purchasing power that's been eroding, compounding
Mm.
at 3% a year. So it's critical for us to help people redefine risk and safety, not in terms of fluctuation in the value of what they own, but in terms of erosion of the purchasing power. And the investments that lead to the protection and growth of purchasing power, I call safe, which are companies' ownership stock, and investments that lead to the decline and diminution of purchasing power, bonds and things that fix our income and the principal that's generating it, those are risky. So imagine, we've got to teach people not only to unpackage the baggage that they've been packed up with, but we've got to tell them the things we're going to now teach them are not just different than what they've learned, they're opposed, they're the opposite of what they learned. Stocks are safe, bonds are risky.
So here, as we wrap, thank you so much for that. As we wrap this episode up, I still want to go back to this last question of how did you? So you were in employment for so long. So how did you start working for yourself? When you went and worked for yourself, how did that happen? And how did you go from an employee mentality to business owner mentality?
Yeah, that's a good question because it's very different. So
Yeah.
we were working in an industry always, right? The investment management industry, where
Mm.
we worked for a number of large firms. Last
Yeah.
one was UBS before we went out and created Fusion. And at UBS, our clients that we had at UBS were an amalgamation of a clients that had begun hiring us as early as 1997. So even though that wasn't our own business, so to speak, they were our clients, as if we had our own business that
Mm.
would follow us wherever we went. So when we decided that the technology in the industry had advanced to the point where we no longer needed the big firm infrastructure to operate, and we didn't use any of the big firm guidance on investments and alternative investments, we never adopted any of that. And so when that became available, having an infrastructure to go on our own, that's when we did it. And that was in 2014, end of 13. And around 2011 is when I really went full on into the idea that helping people understand their behaviors and modify when needed is the most critical element to help people succeed. So we built the whole new firm on that philosophy.
So I love that you're not only just helping them with the money, you help them with the mindset first in order for them to have a healthy pot and understand how the money is going to be invested, which I think is crucial.
You're right. I mean, I always tell people I look at my role for them if they hire us twofold. One is to help them with a plan that will likely get them to where they need to get, and to fund that plan with investments whose historic returns, as against the historic rate of inflation, would have yielded the results that they're looking for. And then the second part is to get them there with as few sleepless nights as possible, right? The money mindset. And you're 100% right. Those are I consider those two equal in terms of my responsibility.
Wonderful. So tell us, Jonathan, how can we connect with you? Where can people find you?
All right, thank you. So they can find us on our website, fusionfamilywealth.com, and all our contact information and information about our whole process that we just talked a little bit about is delineated on that website.
Wonderful. So if you are listening to us on the podcast, the link that Jonathan just mentioned and all these other links would be on the show notes. And if you're watching on YouTube, then down below in the description section, we will have all the links that for Jonathan. Do check him out. Just a quick question, Jonathan. Do you help people outside the US, or are you US focused only?
We do have some clients outside the U.S. So each country has different regulations. So, for example, the U.S. doesn't have an agreement with Canada, so we can't actually service a Canadian client. But yes, we do have clients outside the U.S.
So even if you are not in the US, if you feel that you can get the help, or you need some additional help with your wealth or wealth management, then do contact Jonathan and see how he can help you. Thank you so much for coming and talking to us, Jonathan. It's been a learning curve for me too. I've learned quite a lot as well. But we have to have you back on Money Talkers so we can carry on having this discussion further. But for today, thank you so much.
Thank you, Gull. Pleasure to be here.
And thank you for listening to me and Jonathan today. I will be back on another Friday feature with another amazing guest, finding out how they changed their life by changing their mindset. Until the next time, this is Gull Khan signing off. Take care and bye for now.